independent, then I would look at A and decide if A looks good and judge it on its own merits. And then I'd look at B and do the same thing. I could invest in one, the other, or both of them, or neither, right? So if my cost of capital were 5%, A and B both look good. In fact, they look good no matter what. NPVs are always positive, and my IRRs are above my cost of capital. In fact, I'd have to have a cost of capital above 27.3% before this one would fall out, and above 36.2% before this one's no longer a good project, right? So they look good either way, but if they were mutually exclusive, then let's see. This one's the best of the two, right? Assuming that they're both acceptable in their own right, the best here is A, then A, and then we had, so A, B looks better here, and then B looked better by IRR. So I can't remember, which one of these did we use? Did we use the 10% cost of capital to make the ultimate? So we said, let's assume the cost of capital is 10%. So we've got that, and we've got our IRR. Ignore these two numbers here. Pretend those don't exist, because those don't reflect our cost of capital. And remember, we had an issue. If they're mutually exclusive, if they're independent, it doesn't matter. We're still going to do A and B, right? But if you're mutually exclusive, A looks better by NPV and B looks better by IRR. Which one did we say we would pick? You guys remember? NPV, because we want to raise the value of the firm the most, and it would rise by the amount of the NPV. Real quick aside. So we should do A. If these are in millions, this firm's value should increase by $12.7 million. So here's a quick multiple choice question. When should the value change by 12.7 million, right? So when? Should it change at the start of the project? B, at the end of the project? Gradually over the project life? Or D, something else? What do you guys think? C? Gradually over time? Who says A? Who thinks B? I'm not gonna get many hands either way on. Who says C? Who thinks D? It's D. So I'm messing with you guys, but it is D. So it has nothing to do with when the project starts, with when it ends, or how long it is. First off, we should expect that the firm's value would reflect the entire value of the project. Not gradually over time, but bam, just like that. But when would it do it? If not at the start or end or gradually over time, when would it happen? The minute the market finds out. When the news is conveyed. I announced today that we're going to do this project, but the project won't start for a year. Maybe I'll have to adjust for that year's difference, time value of money, right? May make it a little bit lower in value today, right? This might be a value a year from today, so discounted another year at 10%, you're going to be around 11 million, 11.5 million. That would be how much the value of the firm should increase today. The minute that the market finds out is when it should happen. Yeah.
Does that mean that they have faith that it's actually going to cost that much?
Yeah, so the market, so now, if I don't give very good information, and you guys in the marketplace, you're making a lot of guesses about how much value that may create. And so as you get more information over time, you adjust your estimates and you change the value of the firm as I give you more and better information. And me giving you information may not be me giving you information, it may be you looking and seeing what's happening and you're revising your estimates, right? But so it's information. It's all about information flow. So anytime investments don't ever reflect when the firm does something, it is reflected in stock prices when the market becomes aware, when the information gets to investors. The investors, if they have enough information, they will adjust for any time value of money differences of when the cash flows should occur versus when the information gets to the market. And they'll also adjust for probabilities, like how certain am I that this might occur? How uncertain? If I think there's a 50-50 chance it either happens or it doesn't, I might multiply this number by 0.5, 50% chance of it occurring. I'm going to bump up your value of your firm by half of that project's estimated value because I'm not certain it's going to occur. But if a month later I feel more confident that it's going to occur, like 60% confident, I'm going to bump up the value some more because I'm going to use a higher probability, right? So it's all about information, how likely we think it is, and how complete that information is. Okay, so just a quick aside, all right? So NPVs are the important number, but the market should kind of assess that and reflect it in stock prices the minute they know it, right? Okay, let's do one other thing here. So if I graph this, let's see, this was NPV here, this was percent here, so like our WACC, our cost of capital, and let's see, what did we have? Let me write a couple of things here real quick. So I think so here is A. This is where the discount rate is 0. So it turns out in that case the NPV is 25 million. This is the IRR right here, right? So that was the 27.3. I'm just going to put 27%. I'm going to leave the 0.3 out just for space. And then if I graph B, then B looked more like this. Here's B. The NPV if the discount rate were 0 would be right here, and that would be 19 million. And the IRR, I'm going to leave out the decimal, is 36%. So why did I put all these up? And so I've got two NPV profiles, right? I've got A and B. So it looks like, again, this is of interest if they're mutually exclusive, right? It just shows that same graph, like with higher discount rates, higher cost of capital, the project's worth less, and eventually it's not good at all. The NPVs are negative, right? So you get a high enough discount rate, your project's not going to be viable anymore. But it looks like for some discount rate, I don't know what it is, above or below that rate, it looks like A is the best project of the two, right? If I have to pick, it looks like A is better than B. Because I get, for a given rate, like right here, A is going to have a better NPV than B. If my discount rate's high enough though, then it looks like for a given rate, B might be the better project over A. And then right here, I'm kind of indifferent between the two, right? You could say I couldn't care less. They both give me the same net present value on these things. So the question is, what is this discount rate right here that makes these two projects have the same NPV, right? This is what you're asking when you saw that slide last week, and at the bottom of it, it had, what did it have on there? Remember that?
I don't remember it.
Let's see if I can find a thing. Somewhere, I'll see where it was. We're going to do what's called the crossover rate. So let me leave that out. So to get the crossover rate, I wish I'd put the cash flows up here. This is referred to as the crossover rate. Actually, this interest rate right down here is going to be the crossover rate. So let's see how we get this thing. I need to put the cash flows back up here. So year, my cash flows for project A. So let's see, they both cost 25 million up front. Okay, there's A. And put the cash flows for B up here, cost 25 million. Okay, so there's my information right there. So here's what I want to do. I'm going to create a third set of cash flows, right? So these are the cash flows for A. And these are the cash flows for B. I'm going to create a new column. I'm just going to call it, I'm going to put a triangle for difference. A minus B. Minus 25 minus a minus 25. That makes this positive, right? They all set. That's 0. 5 minus 20 is going to give me a minus 15. 10 minus 10, 0. 15 minus 8, 7. 20 minus 6 is going to be 14. And I want to take this right here. So these are my cash flows right here. Okay? In fact, let's go to the calculator real quick and let's plug those cash flows in. So I'm going to go here to cash flow feature and clear it out and put them in that delta or triangle column. Today is 0. A year from today it's going to be minus 15. Enter that. 2 years today, 0. 3 years, 7. And then 4 years out, we've got 14. Those are the cash flows. And by the way, those aren't project cash flows. It's the difference between the two projects, right? And what I now want to do is go to the IRR screen. We're not going to do NPV. Go to the IRR screen and simply compute. And when you do that, we're going to get IRR equals 13.525%. That is the crossover rate right there. 13.525%. If we went back and put the cash flows for project A in that and use 13.525% of the discount rate, we record our NPV. Then we go and put the cash flows for B and use that same discount rate, we're gonna get the same NPV. So that's where these are equal to each other, right? That's how you find the crossover rate for a set of projects. So, what can we now say? We can now say for A and B, as long as the cost of capital is less than 13.5%, A is the better project. Above 13.5, but below 36, B is the better project. What's the better project if the discount rate is 40%? What is the cost? Neither, right? Neither, they're both negative, right? This one's already negative, A, and B's now negative, right? So could there be situations where two projects and neither is worth doing? Yeah. The discount rate's high enough, that's going to happen. It'll always happen. All right, so that's that thing. Let's see. Let's do a little bit different one. This one isn't in the slides. It's a problem in the back of the chapter. Let's look at it real quick. This is going to be a page earlier. It's going to look different. It's going to look odd. So here, normally we've got what? We've got outflows and then inflows, right? You pay some money, you get some benefit. And we're hoping the net present value is positive. So the benefits outweigh the cost in time value of money sense. But what if you're buying some equipment, so like you're buying a conveyor belt, and that conveyor belt cost $500,000 today. But then the conveyor belt actually is gonna have an annual expense attached to it. So another $120,000 for years 1 through 4, and then 20 in the final year, right? Nothing but outflows. Or you can get a forklift, so you're not gonna have a conveyor, you're gonna have the forklift instead. It's gonna cost less, but the annual expenses to run it are gonna be more. You gotta have one of the two. So here, it isn't like which one's, it's not like this, like one's gonna have they're both gonna have a positive NPV. If I discount those numbers since they're all negative, I'm gonna have a negative NPV. But in this case, since we're gonna say it's an expense that I've got to take, I want the one that's what? In fact, let's work through the math real quick, right? Let's work the math on this problem here. This is a mutually exclusive set of choices. So between the conveyor and the forklift, let's see what happens. So let's bring up the calculator real quick, and let's get this in. So I'm gonna do the conveyor first. 500. I'm gonna do I'm not gonna do the whole 500,000. Just 500 is gonna be in thousands. Okay. So 500,000 there. Then it's followed by 100. Let me go back. Negative. And it's going to be followed by 120,000 negative. And that's going to occur for 4 consecutive years. Let's make life simple. So the frequency is going to be 4. And then the next cash flow is going to be the negative 20 in year 5. Okay? There's my cash flows. Let's get the NPV. So it says up here my cost of capital is 8%. All right, so cost of capital right here, 8%. So let's go to NPV, let's do 8%, and let's see what we get. Compute minus, right, negative. All the cash flows today, all future years are negative, so NPV is going to be negative. So for the conveyor, we have an NPV of minus 911,000, okay? Let's go back and let's do the forklift. So let's go back in here, let's clear the cash flows out. Let's plug in the forklift. Minus 200,000 initially. And then each year's 160 outflow, so 160 negative. And that's going to occur for 5 consecutive years, so the frequency is going to be 5 instead of 1. Okay, I want to compute the NPV once again, so let's see, 8%. And NPV is let's say 839. So this is the forklift, 839. What's the proper investment decision for this firm? The forklift, right? Now you gotta be careful here. You might, if you did look at the cash flows and understand what's going on, you would say neither because they're both negative, right? But here, if we're saying we have to do one of these because we need the equipment, and it's going to simply be a sequence of cost all the way through, we want the one that's the least negative in this case, okay? So here, we want the forklift because it's least negative. This is a rare one. This is one that I don't always show this because I don't want you guys thinking like we always take projects that have a negative NPV. We don't. It's an expense. We want to minimize the expense. So the least expense between the two. Is there another way we could have done this problem? We could. We could do this analysis over here, right? We could take the difference in cash flows year by year. So let's see what that would look like. If I did that, let's see. This goes on for 5 years. So I've got conveyor, $500,000, the forklift minus 200. I'm going to take the difference in those. That's going to be that delta or difference column. That's going to be minus 300 up front. The forklift is 300,000 more expensive up front, so negative 300. But in year 1, minus 120 there, minus 160 here, a positive 40. it's 40,000 less expensive in year one to do the conveyor, right? It costs me more up front, but it's not as bad in year one. The same thing in year 2, and in year 3 and 4. And then the last year, it's 120,000 less expensive. Let's take this column and put these cash flows in. Okay, let's do those. So let's see, I clear that out. So 300,000 negative, that's my initial cash flow, or the difference in them. And then I've got 40,000 plus each year for 4 years. Followed by 120. Right, let's go compute the NPV again. So 8% is my discount rate. And we get, make sure I've got those in there right. 300, it's 40, 4 years, 120. Yeah, okay. So NPV, we got minus 85.8, got minus 86,000. What does that mean? It means C minus F, conveyor minus forklift, right? We're comparing the conveyor versus the forklift. So these are what we call incremental cash flows. You'll hear that term again in the next chapter. These are not the cash flows of the conveyor or the forklift, but how much they differ between the two. And that's a lot more expensive up front, and then some benefits. So it's more expensive to buy the conveyor up front, but we get benefits by having it, so we have lower expenses in the years that follow. This looks like the traditional kind of cash flow patterns we see, right? And what do we want here? We want that to be positive. It's negative. What does that mean? That means conveyor, if we choose the conveyor over the forklift, it's worse. It has a negative NPV. Put different, yeah. Where is he?
Why is it 120 for 160 with the 20?
Wait, say it again?
You put for the change for 160 to 20 for 5.
Oh, 140. That's it. That's what you're asking about?
Yeah.
That's what that should have been. Let's go back and change that. Let's see. 120. Let's make it 140. And NPV, let's see, minus 72. So the conveyor project is $72 million more expensive in NPV than the forklift. So the conveyor looks worse than the forklift. So that's another way, when you have mutual exclusive projects, you don't have to analyze each project. You could look at the difference in the cash flows. And if you get a negative NPV, then it means the first project who you've got, like A minus B, then A is not the better project, B is the better project. If you got a positive over here, that would mean that the first project you're differencing, C minus F, C is the better project in that case.
And if it's 0, it's just.
You're indifferent between them. They have the same NPV. So in other words, these would have been the same number right here. We could have told, we knew this was going to happen because we did this and that number was lower, right? There's just a different way of doing it, right? By looking at the differences in these things. Why is that relevant? Say you went to a car dealership and you're shopping for a car and you've got several different financing plans. So you run each through your calculator. You could do them separately and get a bunch of NPVs. Like which one's gonna, when you buy a car, it's gonna be a bunch of outflows, right? So you could see which one's the least negative, or you could take the difference in the different plans and see which one, right? Which one gives you a positive NPV, means that it's incrementally better than the other, is what you're looking for in that case. So it's a different way of looking at it. All right. I don't often show that in here with that problem, but it does come up a lot at times in corporate finance where you get managers who look at a couple of projects that are mutually exclusive, And they'll look at the project A and B per se, look at the difference in the two, which one is incrementally better and by how much. And you'll see that kind of analysis. All right, let's do another problem here. Let's see which one next. Okay, let's look at this thing called the profitability index. Let's do it next. So, the profitability index is simply, as I've got that equation kind of small print up there, it's the present value of your future cash flows, that's year one to the end of the project, divided by the initial cost or the investment, that's the year zero cash flow on the project, and that's your profitability index. Alternatively, you can compute this a lot easier by getting the regular NPV, divide that by the initial investment, and then add 1 to that number. And that's the profitability index. Let me show you real quick. So back on this thing I just erased. So here was project A that we had a little while ago. Cost 25, and these were the cash flows. And we did the NPV at 10%, and we got $12.7 million. That was the NPV for that project. And then for project B, we had 11.6 million for it. So here's how we could go and take those numbers and get the profitability index. So the profitability index for A would be 1 plus the NPV for A over the cash flow in year zero for A. So that would be 12.7 million. And the initial cash flow, I'm going to leave the negative sign out. Do not put the negative in there, right? So you get just 25. So this is going to give us 1.508. That's the profitability index for that project. Okay? I can do the same thing for project B. That's going to be 1 plus its NPV, 11.6 million, over its cost, 25 million. So we're going to get 1.464. All right, so it's pretty easy to compute it. That's the easiest way to compute this number. So 2 stages. Get the net present value, that's stage 1, and then run this equation here, this calculation, and that finishes it. So let me describe what, or tell you what this number means, then we'll figure out what the decision criteria is, okay? First off, it's in present value terms, but it's basically saying how much present value benefit are you getting for every dollar of cost, right? So this says I'm getting $1.50, basically $1.51 benefit for every dollar of cost when it's been converted into present value terms. Or put differently, 51 cents in benefit more than I'm paying out in cost. This one is giving me, in present value terms, $1.46 in benefit for every dollar of cost. I'd rather have a larger profitability index than a smaller one, right? Now, what do I definitely want this number to be above? Above 1, right? It's benefits to cost. It's a benefit-cost ratio. In fact, this is sometimes referred to as a benefit-cost ratio. So it is 1 plus your benefit to your cost. I want the number to be above 1. So let's put our rules back up here again. For NPV, let's see. Undo this. We said that we're going to accept a project let's see, if NPV is greater than 0, and even if it's equal to 0, we would accept the project. And when that occurs, we found out the IRR will be greater than the WACC here, equal to the WACC here, and then reject. We had that, right? So that was the stuff we did last week. Here, with the profitability index, it's going to look like this. I accept if it's above 1. If it's above 1, NPV is going to be positive, the IRR is going to be above the WACC. You get all those lining up. If the NPV is negative, think about it like this. What if this had a negative NPV? Then this would have given us instead about 0.49 is what it would have given us. Below 1. In time value of money terms, the benefits are 49% of the cost. That doesn't sound very good. So we want to reject that. So if the cost benefit ratio, this profitability index, is less than 1, it's costing us more than it's benefiting us. We would want to avoid it. If it's equal to 1, then it means that's the case where NPV 0, we're earning just our cost of capital. Remember what happens to the value of the firm in these cases? Which of these cases did the firm value go up?
First one.
The first one, right? So firm value is going to increase in this case. Which one would it decrease?
Reject.
Yeah, it's going to go down here and then no change here, right? So you see, these rules are telling us mostly the same thing, right? So question would be, why do we need a profitability index if it tells us the exact same, gives us the same decision that NPV or IRR did? Why would we need that? Here's the situation in which we tend to use it. Something called capital rationing or capital budgeting. Or not capital budgeting we're going to be doing in these chapters, a little bit different. That homework, you guys had GE, right? You had to do the cost of capital for GE, and they had several different divisions, right? They had like aviation and healthcare and a couple of other divisions. In theory, from a classroom perspective, we'd say that each division goes out and they search out for opportunities, investments they could invest in, say for the next year or the next, whatever period of time, a year or 5 years, whatever. And they come up to the CEO and the board of GE and they say, like aviation's found these 12 projects that look really good. They have positive NPVs, they're independent, let's invest in all of them. We need $5.5 billion of capital to make this investment. Well, the boss of GE says, yes, they're all positive NPV, they're gonna raise our value. Yeah, we're gonna do every single one. And the CEO and the board does the same thing for the healthcare division, the power, all 4 divisions. They simply say, every project that we can invest in that you've deemed has a positive NPV, we should invest in them because it increases our value, maximizes shareholder wealth. There's a problem with that, is that when firms do this, they tend to go out and raise capital, and they've got that capital available. And that's based on typically like a 5-year plan, right? And so we've raised a whole bunch of money from debt and issuing stock, all this kind of stuff. And now we find out that, you know what, you found some new investments because new opportunities came up in the market. Do we go and do we raise more capital? It's only been 6 months. Or do we simply go and juggle around our existing budget and pick out the best of the good, viable projects? See what I'm getting at? So maybe firms don't always invest in everything that looks good. Maybe they have to invest in a subset given their budgetary constraints. That's where this thing called capital rationing comes in. It's basically a budget constraint. So let's look at this problem here. INV, this is our investment. This is our initial time 0 cash flow. These are outflows, okay? So I got 8 projects, they're all independent. That's important. These are independent projects. I'm not trying to pick the best. I can invest in each and every one as long as they're acceptable. I've got NPVs, and then I've got profitability index right by it, okay? So, for example, project 7, has an NPV of 5,000, it costs 150 grand at year 0. To get that profitability index, that benefit cost ratio, I took 5,000 divided by 150, then added 1, I got 1.033, okay? But you can kind of tell, let's see, should I invest in project 1? Yeah. Positive NPV, hey, the profitability index is above 1. 2, positive above 1. Heck, go right down here to 7, positive above 1. Those first 7 look good. Number 8 doesn't. So this hasn't done me anything extra, it just added more work to do this. But here's where the benefit of this cost-benefit ratio comes, or benefit-cost ratio comes in. So I've determined that number 8, I'm not going to invest in no matter what. It's a bad project. But 1 through 7 look good, but when I went to the CEO and the board, they said, your division has a budgetary constraint. We're giving you $1 million to work with. That's all you got. It doesn't matter that you've got 7 good projects that will cost you more than $1 million in total initial cost. If you add those numbers up, that's going to be well over $1 million, okay? So I need to pick the projects that give me the most NPV while spending no more than $1 million. So how can I do that? Well, I could try trial and error every different combination I could and see which combination of projects here spends up to but not more than $1 million here, and see what the total NPV is. An example, what if I said, let's try, I kind of like 5, and 5 is going to cost me $275, and the NPV is 21 million or 21,000. I'm going to try number 7. 7 is going to cost me 150. It gets me another 5,000. So far I've spent 425, and I've gotten benefit of 26. I got a budget of $1 million, so I could throw another project. Let's throw project number 3 in. So I would throw in number 3. I spent 925, and its NPV is 41,000. That's 67,000 total so far. I've got 75,000 more I could spend, but I don't have a project up here that I can fit in that budget now. So the maximum I can increase the value of my firm is that total NPV, 67 million. Could I try other combinations and get a higher NPV? Maybe. A lot of trial and error. So here's the easy way to do it. Instead of focusing on this, compute the profitability index and then sort it in Excel from best to worst. And the first project you should invest in is the highest PI, followed by the next highest, followed by the next, until you've used up your budget. So you notice what's happened. The best project cost $275, right? So I spent a total of $275. I'm going to do that project. I've still got more budget, $1 million total, right? So I'm going to do project 2. That's my next best project. That's 200. So these combined cost me 475. Right? So I spent 475 out of $1 million. I still have money I can spend. My next best project's 3. It cost me 500. So with 3, I'll have spent all 3 of these here, 975 total. Now, I still have 25,000 left out of my $1 million, but I don't have anything up here I can buy for that. So let's see, what have I done so far? Well, I'm going to have these 3 projects, and that is 60, 20, and 41. That is $121,000 of NPV. That's better than that one I got over there. That combination, those 1, 2, and 3, that's the best combination I'd find. So the highest PI'd projects until I've used up my budget constraint, right? I haven't gone over the constraint, but I've gone just up to it as far as I can by getting the best profitability index numbers. So that's where this thing comes in. So firms that have a budgetary constraint, whether it be for the firm as a whole or for their divisions, they should use profitability index to figure out which independent projects they should invest in and which ones they're going to have to simply let go, right? They use this rule here. You know, I mentioned that, you know, firms will go out and like, they'll budget out a number of years, and then you may come in and say, you know, we have this limited budget. Here's some additional reasons that firms ration capital, instead of continually going to markets. So for example, you know, what's happening in markets nowadays, you know, as much as we hear fears of recession and everything, firms still keep hiring. And job openings there are lots of them. I mean, even in finance, usually this is the time, you know, when you have down markets and everything, that's usually the time when employment prospects aren't too good for new grads. But right now, they're pretty decent. Firms are hiring, they just can't find skilled talent anywhere, there's not enough of it. You guys are in a good situation. What would that do to a firm in the financial sector that wants to expand? They've got good projects, have a positive NPV, but they can't find the talent. They can't do much about it. So maybe it's not just a matter of a budgetary constraint. It may be they've got this amount of talent they can work with, right? A labor pool. They can only afford to do just so many projects. As a result, they want to take the ones that benefit them the most. So this PI index will help us out with that. Okay, let's see here. And you can see some others. Sometimes capital structure is a limiting factor, so your mix of debt and equity. Sometimes your dividend policy is going to be. We'll talk about those again later on in future chapters. So that's capital rationing. In that situation, we use the profitability index to figure out which subset of independent projects are the best, right? That's when you use it. Okay, let's look at another special circumstance. Now, instead of multiple independent projects, let's say we've got multiple mutually exclusive projects. We want to pick the best, but they have different lifespans, okay? So now we're gonna have two different rules that can do the same thing for us here. We have two rules that can give us a decision. So let's look at what we've got here. So I've got projects A and B. I've got to pick the best of the two, okay? Cost of capital is 12%, so I get NPV is 8.1 and then 9.3. And it looks like B's the better project, right? I should take B. I can only take one or the other, and they're mutually exclusive. B looks better, higher net present value. But there's a problem with this. What's the problem here? Takes twice as long, or put differently, by the end of the 5th year, I freed up all my capital. I can reinvest for another 5 years. In other words, this is basically saying, I'm just sitting here, I put my money in an empty coffee can and buried it in the backyard, when I'm probably gonna reinvest it in a new project for the next 5 years. What happens to the NPV then, if I've done this and then something else here? It's probably gonna be higher. How much higher? Maybe more than 9.3, it might be better, right? So what do? Do I have to go find another project to put in place at the end of year 5 that goes on to the end of year 10? I could, but I doubt I have anything right now, right? That's kind of forecasting out a lot. So we have to make some assumptions. So the best way to do this, to fill in this gap right here, is to say, you know, project A is a 5-year project, and project B is a 10-year project. What if I did project A twice, back to back? In other words, when I'm getting my last cash flow here, I'm gonna go and pay the initial cost to start it over again. It's gonna look like this. Oops. It's gonna look like that. So here it is. Here's A. It initially had outflow of 100 and then 30, 30, 30, 30, 30. But on that last year, I've got to pay to start this project back up again for the second time. Let's say there's no inflation, so it's going to be 100 outflow again. We could adjust these assumptions and allow for inflation and everything. So 30 in, 100 out, that is a net outflow of 70. There's my cash flow in year 5. My cash flow then isn't 30, it's not minus 100, it's those two together. And then what do we get? We get those 30s that we would get for the next 5 years, where there's the next year, 2 years, 3, 4, and 5 years, right? Doing the project a second time. So what I'm gonna do here, I'm gonna ignore these two things. Those gave me the 70. So I'm gonna take that column right there and do a net present value. I'm gonna get 12.8. And since that is a 10-year sequence of cash flows, and that's a 10-year sequence, they have comparable lifespans, I can make a decision on these two numbers, and now I can say that looks a heck of a lot better than that. I should pick project A. So this is what's referred to as replacement chain NPV. And it accounts for projects that have different lifespans, but they're mutually exclusive. Now, that's an easy one. That's easy to understand. It's fairly easy to implement. It could be time consuming if I've got a lot of years in a project. And it could be time consuming in other cases too. So for example, what if I had two other projects, C and D, and let's say lifespan of the project. Let's say C was a 3-year project and D is a 7-year project. So what happens? Well, let's replicate this one extra year like I did for A. That gets me out 6 years, right? Not enough. I still have a year gap. Let's replicate this 2 times. That gets me out to 9 years, which is more than this. See what's happening? So I want to have a common lifespan between the 2 projects. So to do that, I might have to do this one a total of 7 times for 21 total years. I might have to do this one 3 times for a total of 21 years so that the replicated lifespans are the same. I don't want to go through the math of doing that. That would be a pain. Yeah.
Just put 27.
21. Yeah. It's Tuesdays are my Mondays. So we can do that in Excel. Even in Excel, it's gonna be a little bit of a pain to do it. We could do it. Once you have the cash flows, it's just a matter of just basic discounting and getting an NPV. So that's simple enough. But is there an easier way? And there is. So what we do is we go back to the original data. We compute the regular NPVs on the original project. So we had the 8.1 million for A and the 9.3 for B. Okay? We do that. And then we compute what's called the equivalent annual annuity. And here's how you do it. So just look at A real quick. So A is a 5-year project. So you're going to get into your calculator and you're going to take, show you real quick. Let's clear this out. You're going to use this row of keys right here, the bond or time value money keys, right? You're going to use those things. So this is a 5-year project. That's going to be N. I is going to be your cost of capital, so 12 is your interest rate. The PV is going to be your NPV that you just computed. So you have that first step. So that is your PV on this project. And then FE is going to be 0, and you're going to compute the annuity payment. You get 2.247, so 2.25. That's the equivalent annual annuity for Project A. In other words, Project A could produce an annuity of $2.25 million a year. If I did the same thing for Project B, B's a 10-year project, so it's going to be 10. I is going to be that cost of capital. FE is going to be 0, just how we do it. This has an NPV of 9.3, so that's going to go into our present value, 9.3. And we're going to compute our payment. That's got an equivalent annual annuity of 1.646. So about 1 2/3 million is the annuity payment that can create. I'd rather have a higher annuity payment than a lower one. So A looks better if it has a higher equivalent annual annuity. That's less intuitive for a lot of people, but it's easier to compute, especially instead of doing all this right here. Right? For this problem, That wasn't too bad, but if I had to do it for more than that one time over, it would be it'd be a bit onerous. All right, so, equivalent annual annuity, replacement chain NPV, special circumstance. We only use this rule or these rules. And which one do you use? Toss up, they're gonna give you the same decision. It does not matter. You use them only if you have mutually exclusive projects that have different lifespans, right? Could be 2 projects, could be 20 projects. We need the best, and they have different lifespans. Compute the equivalent annual annuity or the replacement chain NPV. Okay, we've got one more of these special circumstance rules. Kind of left the best for last or the worst for last. So we're going to do a couple of examples of this one, okay? So we've got one called the modified IRR, the modified internal rate of return. Right there, okay? Modified IRR. Let me show you what's going on with this rule first. Let's see, let me back up here. Here's that problem that we did to get NPV and IRR back on Thursday, right? Here's the cash flows. We got a positive NPV, we got our IRR. Here's what the NPV profile looked like. That graph, we've seen it before, right? It looks very intuitive. As my discount rate gets higher, my NPV gets lower and lower, and eventually goes negative. That makes common sense. Here's an interesting project. Here are the cash flows. Initially, there's an outflow, 800,000. Year 1, inflow, 5 million. Year 2, an outflow of 5 million. If I graph the NPV profile, it looks like this. You see how peculiar that thing is? It's negative. So this project is a loser at discount rates below 25%. I go borrow at a reasonable rate, it's going to be a bad project. It's also a loser at cost of capital above 400%. I hope I don't have a business where I have required returns of 400%, right? Between 25% and 400%, this is a good project. In other words, if I borrowed money from the Italian mafia, from Dr. Giudici, right, and my cost of capital is say 250%, right? So you know like how they are, you know, in Sicily. Joking, he doesn't come from Sicily. You say, I've heard you come from Sicily. Then it's positive. It's a positive NPV. It's a good project. There's something weird going on here. We got to figure out what it is. But all this was I did in Excel. I took these cash flows, and for a whole range of discount rates from 0 to 500%, I computed the NPV and then graphed it. And this is what I got. Okay? This is what we get here. And then we know that mathematically the IRR is the discount rate that makes NPV equal to 0. And I can see I've got one right there, and I've got another right there. I've got 2 of these things. I knew I was going to have 2 because my cash flows changed sign from negative to positive and back twice. If I'd had a bunch of years of cash flows and they changed 5 times in sign, I'd have had 5 IRRs. If I'd had 50 years of cash flows that had changed sign a dozen times, I'd have had a dozen IRRs. That brings up an issue. What if I said that my cost of capital is 30%? Do I say, my IRR is 25%, that's less than my cost of capital of 30, I shouldn't do this project? Or do I say, no, it's 400% is better, I should do the project? See, I don't know which one to use, right? Some people might be inclined to say, well, let's take an average, 425, let's average that, and if the average is better, you can't do that either. Some people would say, and I've seen this, well, you can't use 400, that's ridiculous. That's just absurd. Let's use a 25, but 25 is less than your cost of capital of 30, so you can't do this project. But you see the problem? At 30%, it's going to give me a positive NPV. I'm going to forego a good project. All right? So somebody simply says, some ad hoc rule, 25% sounds reasonable, 400 doesn't. Let's use this as your IRR compared to your cost of capital. I might make a bad investment decision on here. How can I get around this thing? I can use NPV. I can clearly see where it's good. I can clearly see where the project is bad. But sometimes managers want a rate of return, like an IRR, right? They want the project to be summarized in an investment return. So here's what we need to do. We're going to take all the cash flows in our project and we're going to push them to either end of the timeline. We're going to take all the negative cash flows and bring them to today by present valuing them. Okay? So we're going to have a present value of all the negative cash flows at time 0. And then we're going to take all the cash inflows, all the positive stuff, and push it to the other end of the timeline, the last date of the project. And that's going to be our future value of all the positive stuff. It doesn't matter how many cash flows you get for how many years, all the positive stuff are going to future value and add those future values up. Same thing with the negatives, present value. And now what do we have? One negative, one positive, one sign change, so we'll have a single IRR, and we're going to call that the modified IRR, because we will have modified the cash flows, so we have one sign change, and as a result, one IRR. Okay? So that's going to be the procedure. We're going to take the present value of all the negative cash flows. Step 2, the future value of all the positive cash flows. Step 3, get the IRR of that modified cash flow sequence. You're done. All right? So let's use this one right here real quick. So here's our original cash flows here. It says 5 million there, minus 5 there, minus 0.8 there, and we're going to use a cost of capital. I guess let's use 10%. Let's say that our cost of capital is 10% for this project. So step 1, I want my present value. So the PV of all the negative stuff will be my 0.8 here. And then the negative 5 here, but I've got to discount that at my 10% for 2 periods. Right? So that is going to give us a negative 4.932. Right? That's the present value of all the negative stuff. Let's put that number right here. 4.932 negative. Okay? In other words, minus 800,000 today, minus 5 million in 2 years. At 10%, those are equivalent to minus 4.932 today. Right? They're equivalent to that. Now let's take this number here and let's find its future value as of the end of the project. This is step 2. So the future value on year 2, project's end, will be my cash flow in year 1, increased at 10%. Now here's where we gotta be careful. We're going to year 2, the cash flow is on year 1. We're going to do another one of these in a minute. Lots of times when people do the future value equation, they end up saying, oh, this is on year 1, so that exponent should be 1. It happens to be that case in this one, but that's not the way you do it. We're going to year 2, we're on year 1, that's a 1-year difference. That's how many years we're future valuing this number. That's going to be 5.5 million. All right, so here's what we've got. We've got FV is 5.5. PV is minus 4.932. Payment is 0, N is 2. And so you're going to compute your rate of return on this. And you're going to get 5.6%. And that is your modified IRR. How do I evaluate this? Is that a good or bad project? Well, here's what you do. You take the MIRR versus the WACC, right? Same kind of decision rule we had before. So the modified IRR is 5.6, the WACC is 10. What do you think we should do? Should we make the investment or not? No, because the MIRR is less than the WACC, right? So reject. By the way, the modified IRR should give you the same decision that the NPV rule gives you. Let's look where that is. 10% is where? It's in here somewhere, right? Negative NPV. We wouldn't have done the project if we computed NPV. So the modified IRR gets around this issue here. And I don't know if I have a graph of that. Yeah, here's those cash flows again, that same graph. Here's what happens once we did that. Those are the modified. That's like a regular NPV profile. That's all from these cash flows here, but for different discount rates, right? And you can kind of see that the IRR for the modified cash flows is 16.87%. So as long as the discount rate's below that, this is a good project. So when do you use this rule? You use it for a given project that has multiple sign changes, and you want a rate of return, an IRR, instead of an NPV. That's when you use this. And what we're doing is we're modifying the cash flows and then computing an IRR and using the regular IRR rule. Let's do one last thing. I think we've got enough time to do it. Let's get a little bit of extra practice with this one. And let's look at project A, okay? Let's look at project A, forget about B right now. So you see what's happening for A, bunch of negatives for 4 years, positives, and then negative again. It's got two sign changes. It goes from negative to positive when we go from year 3 to 4, then it goes from positive to negative when we go to year 7. This is going to have two IRRs. We cannot use that rule. So we're going to compute the modified IRR for this. And we're going to use a cost of capital of 12% right here. All right, so we're going to use 12% as our cost of capital. There. Okay, let's see. Let's get my PV of all my positive cash, or all my negative cash flows, excuse me. PV of all the negative stuff. So let's see, I've got the initial cash flow at time 0, minus 375. And then I've got year 1, I've got minus 300. I'm going to discount that at my cost of capital, 12% for a year. And then I've got year 2. And then I've got year 3. All right, so I got those. And then I've got way out in year 7, minus 200. And I'm going to discount that at 12% for 7 years, right? I'm going to do that. Like, what about years 4, 5, and 6? Those are positives. Those aren't going to be in my PV, okay? So let's get this. So this is going to be 90.5. That's going to be 71.2. That's going to be 159.4. That is 267.9. And then 375. I'm leaving the negatives out. You could put the negatives in there. That's fine. Right, so we're going to get, we're going to get 963.90. Okay, that's the present value. So that's step one. Step two, we want to get the future value. And I want the future value as of year 7 because that's the last year of the project. This is going to be only the positive cash flows. So the first positive is in year 4. So I get 600. That's going to be compounded at 12%. What's the exponent going to be for that one?
3.
It's going to be 3, right? So be careful with this. A lot of people will say, oh, the exponent should be 4 because it's in year 4, but that's not true. We're going from year 4 to 5, 6, 7. We're going 3 years into the future. So the exponent is going to be 3. Right? And then in year 5, we get another 600. That's going to earn 12% for the year 6 and 7 for 2 years. And then in year 6, we get 926. That's going to earn 12% from year 6 to 7, so for just 1 year. So that's 843 for the first cash flow. That's the second one. And then the last one. All right, and so we work that out, and we're going to get 2675.20. Okay, that's step 2. Step 3. Take those numbers. PV is a negative 963.90. FV is what we just computed, 2675.20. Payment is 0, and N is a 7-year project. So let's get all of those in there. And we're going to compute the interest rate, which will be our modified IRR. And that is going to be 15.7%. And since that is greater than our WACC, which is 12%, that gets us to step 4, which means this is a good project. It would have a positive NPV. All right, so this project, without going through it, it's going to have 2 IRRs. I don't want to compute them because it's a pain, but I know it's going to have 2. If I graph it, it's going to have that hump feature that we saw a little while ago. But I do know that at a 12% cost to capital, this project will be viable, have a positive NPV. The modified IRR is above my WACC, so it's what it's telling me. It's a good project. All right, now, is it worth going through all this pain if you have a project that looks like B? How many IRRs are there for project B? Because there's 1 sign change. You don't need to do this. You can do the regular IRR for project B without having to go through all this extra trouble, right? So there's extra work involved in this procedure. It only makes sense to do it when you need to do it, and that is when you have what we call non-normal cash flows, multiple sign changes, and you want a rate of return instead of an NPV, you do the modified IRR, okay? So, you guys get out of here, you end up doing this like you go into corporate finance and you do capital budgeting. You could have bosses that say, now I don't want to see an NPV, I want to see an IRR. And it's like, but it's got multiple sign changes. Well, you make it work, right? And this is how you would do it. I've seen this happen before, so it does actually occur. It is something to make a busy life for you guys, but it actually does occur. Okay? New chapter on Thursday. We'll get to the one that looks at cash flows.